Alrighty guys, so in today's video we're going to be talking about the importance of stop loss placement as an ICT trader. There's definitely been times where you've put your stop loss in a certain position, you've been stopped out and it goes in your favor, or you put your stop loss in a certain position and you think, oh, maybe I shouldn't have put it there, maybe I should have put it a little bit less. So there's two variations that we're going to talk about today, and we're going to go through 5 different examples of where I've put my stop loss based on different trade setups and market structure. But without further ado guys, let's get straight into the video. So I think I just want to start off by saying, in this module, in this educational series, this is, one of 10 videos. It's a free mentorship I'm doing based on ICT concepts. These are like 10 educational things that personally I've taken forward or taken from ICT, and they've helped me gain profitability and actually gain that consistency, right? A lot of the concepts you learn, they're not really that important, but these are the 10 key things that I've kind of put together. Again, if you want this PDF, let me know. This will be all accessible in the free Discord, right? All these 10 modules, the videos and the PDF. So check the link in the description and that will be there for you guys. But let's get straight into it. And again, I just want to go through multiple examples. We'll get straight into the first example here and we'll have a look at what price action is doing. So just so you guys can see, if we zoom in a bit, the blue line represents my entry, right? The red line represents my stop loss and the green line represents my take profit level. Now, first and foremost, I want to keep in mind that this is a macro trade, this one here that we can talk through. You can see the execution arrows too. So these are all personal trades that I've taken. So that's where I've sold and that's where I've bought back. And most of the time for these trades, they're 2 contract trades. Sometimes it'll be 1, and we'll talk about how I manage that as time goes on. Now, the question you might have is, okay, in this first example, why is my stop loss there? Well, in this example, guys, I'm making use of a sweep of buy side, right? There is a shift in structure here. There's an inversion fair value gap. There's another inversion fair value gap here. There's a sell side imbalance, which becomes a breakaway gap. And we've also got an order block, right? So these 2 up close candles are an order block when price breaks below. So my stop loss in this position, it's a very generic situation where your stop loss goes above the swing high that rated liquidity or below the swing low that rated sell side. It's the same kind of thing. And this is a very generic situation, but in this case, I'm more than happy to have my stop loss here. And it's exactly what I've talked about here. Most of the time, ideally you have 3 PDRAs supporting the trade. Ideally, right? Now this is great in theory, although sometimes price does not allow for it, which is really important to keep in mind. So in the example below, again, I've denoted my entry in blue, the stop loss in red, and the take profit in green. Normally in this situation, right, I could technically put it above this order block here, but because this range is so small, right, roughly, about 5 to 10 handles for London session is a good stop loss placement. Because it's so small, I'm happy to put my stop loss there and give it more supporting factors, you know what I mean? Because there will be times where, price could come up here, just sweep this high with a wick and then reject and then go in your favor. And you might have had that happen time and time again. So for me, a big, factor in terms of where I put my stop loss is what's the price structure, number 1. How big is the stop loss in terms of handles or points, 5 to 10. It depends what session you trade to. If you're trading the New York session, there's no way you can have a 5 handle stop loss. It's probably going to be 15, 20, 30, depending on how you manage your trade. And this is a very typical example, right? So stop loss is here. Now, when price starts to move down, so when we have this big displacement candle here, you might say, well, does your stop loss stay where it is, or are you going to trail your stop loss as price goes on? And let's talk about it. So as soon as price breaks down like this with some displacement, and now we've inversed this bullish fair value gap here, there's no way I'm leaving the full risk on the table. So automatically I'm going to come above this swing higher, and then I'm going to watch price. When price starts to do this, I'm going to go to break even. Why? Because I don't anticipate price to go all the way back up again. That would be really messy price action. And mind you, we've just tapped into this bullish imbalance. So if I'm wrong, if my trade ID is wrong, we could reverse from here. So because of that, because we're getting to like a key zone in OT of this previous range, and because now we've returned to an imbalance, I'm going to move my stop loss, I'm going to mitigate my stops, and this is just what personally I do, right? So start off here, drag it down a little bit as price moves down, and then as we displace and tap into this imbalance, I would be at break even. When we have this, right, when we break down like this, my stop loss is going to come really aggressive. Like I trail it really aggressively, because what's the point of me being in this trade all the way from here to here? Maybe you get like 9, 10 handles. Maybe I'm aiming for 12 here. And then get stopped out. There's no point. So I'll trail my stop loss aggressively at this point, right, in this situation. probably above these candles here. If I get stopped, it's still profit. If it works in my favor, take those extra, 4 or 5 handles, happy days. And then again, obviously the take profit gets hit. That's how we do it. So again, that's just one example. We're going to go through 5 examples today. Let's get into the next example, guys. So example number 2. So in example number 2, let's talk through this. And again, if you want this PDF, guys, let me know, but it's going to be in the description in my free Discord. So join that and everything will be there. It's going to be classed as the free mentorship and it'll be a playlist on my YouTube channel. Now, this example, you might say, well, why'd you enter? Where'd you enter from? Where's your TP? Where's your stop loss? This is a typical situation where you've got a range, right? You've got this high, you've got this low. We've talked about this, in previous modules. I pulled up a Fibonacci. We returned back into OT of that range, and then we had a rejection. Beautiful. So my entry comes here with the blue line. My stop loss goes here. My TP's here, right? My overall TP. 3 contracts, right? 1 entry. In this case, you can appreciate that the stop loss is not going above more than 1 or 2 PD rays. These up close candles, by the time I enter, they're not even an order block yet. So realistically, there's only 1 PD ray that's there. And you might say, well, Ruben, that's not enough. Why doesn't your stop loss, Ruben? Why doesn't the stop loss go above this swing higher? Why? Because it's too wide. And I'm placing my stop loss in a position where if I get stopped out, my trade ID is invalidated. So in this situation, my trade idea is this. We've returned back into OTE, we're still bearish. So because we've got a rejection at OTE, inversion fair value gap, I'm going to enter. My stop's going to go above this high because I've got to permit price, if it wants to return back up and potentially wick in this zone. Now I go about 1 or 2 ticks above, right? There's no real fixed thing for me. It's 1 or 2 ticks, give or take, but I don't go on the high or low. I always go a little bit above, just a little bit, just in case, right? Very rarely, but just in case, right? Price wants to just wick just here and then reject. And then later on, it might form like equal highs, for example, and then it'll come and take that out. So that's one reason why I personally do that. But again, that's the entry there. That's the stop loss and the TPs here. I've taken partials. So for me, if I'm in with heavier contracts, I'll take partials. That's just how I do it. 1 to 1, 1 to 1.2, that's maybe a 1 to 1.6. So as you can probably appreciate here, the stop loss is placed in a position where if I get stopped out, my trade ID is invalidated. 1 PD array supporting price because that's all the market offers. I'm not going to put my stop loss here because it's too much of a risk with 2 contracts or 3 contracts. There's no chance I'm going to be risking this much on 3 contracts, right? So I have to lower my risk. Because I'm in with heavier risk, I've got to tighten my stops in a position that makes sense to me, right? That's really important. If you look at this one, guys, that's probably like a 1 to 2.5, right? This is probably like a 1 to 1.7. So the risk to reward does change. I take what the market offers me. And again, the TP here is the bodies of these candles, right? Lots of volume there, and I want to make sure I take those profits. So example 2, guys, with the stop loss placement, hopefully getting something from this video. It's a really important topic, I think, to discuss, and I'm talking you through different examples, how my stop loss would change. But let's get into example number 3. Let's get into it. So example number 3. So in this third example, there's a few differences now, right? We're looking at SMTs, we're looking at, higher lows, we're looking at differences in how I manage my stop loss. And let's talk about it. So looking at this image here, you can see what I've marked out. I've marked out SMT, right? So we form this low, we come up, we have a shift in structure, we come back down into OT of this range here. Great. We just place high, we come back down into OT of this range here. There's SMT, there's lows. In other words, the NASDAQ is making higher lows and ES is making lower lows. That supports my idea that price might want to go higher. Now, I've entered from an inversion fair value gap because that's what's offered to me. So I'm going to enter from whatever PD array is offered to me. It could be a return to a bullish gap. For example, we'll talk about this. It could be an inversion fair value gap. It could be an order block, a BPR. It could be a turtle soup. It honestly just depends what is offered and what my narrative is for that particular session over the next hour or so. SMT, the lows, we just place higher. My entry comes here. My stop loss is below the swing low that created the SMT. I don't want that low to be broken. Why? Because then the SMT will no longer be present and therefore my trade ID is invalidated. So it's something very similar to the last example where after entering, my stop loss is placed below the SMT low because if that gets violated, my ID is incorrect. It's wrong, right? Now I've seen, here's the interesting thing, right? I've seen this inversion fair value gap be used once, twice, and 3 times as some kind of resistance. As soon as we break past that, that becomes an inversion. So what I've done here is when we've retraced back into this busy, I've entered another contract. Now, ideally, I wanted price just to accelerate from this point, and we'll talk about why I took off the contracts here. I didn't really like how, price action developed. We swept that low, little turtle soup, executed the position. At this point in time, you might say to me, Ruben, well, where's your stop loss now? Like if you've entered a contract here and then a contract here, where's your stop loss? Like where's your stop loss? As soon as I enter here and we reject that, my stop loss is being brought right below these swing lows. This point here. I want to see that as a breakaway gap because now we've swept liquidity, we've tapped into this big inversion and this busy. We should not need to reprice lower. We should not need. If my theory is correct, we should be able to push higher. Now we do push higher, take off one contract, the original one down here, and then price just doesn't really project as I want it to. So what do? I call the trade. So this is something really important if you're pyramiding positions, and sometimes I'll do this, one contract, second contract, or two contracts, the third contract, whatever it might be. You got to watch price action and decide for you what makes sense. What should price action do? Where should price respect? Where shouldn't it respect? And sometimes you're going to get it wrong. As a human, as a trader, you're going to get it wrong sometimes. But I think it's really, really important to keep this in mind because realistically, in this situation here, if we would have expanded up, then all I would have done is brought my stop loss from here below this swing low. Right, so I mitigated this one into profit, right? This stop loss was in profit now. The other one would have been roughly break even if I was to get stopped out. And that's how I kind of manage the trade when I'm pyramiding in, if I'm going in with more than one contract. But this illustrates how you can use SMT, right? So this is with an SMT low. If we go back to the previous example, it's using OT of the previous range. The first example is just a typical sweep of liquidity, shift in structure, but using like an inversion fair value gap. So it depends on what price action is giving me, right? In terms of risk to reward, you can see it's not a massive risk to reward. It's probably like what, a 1 to 1.6. So in this example, have a little bit of a look. Again, we've marked out both the entry, the TP, and the stop loss. And you might be like, wow, that's interesting. Why isn't your stop loss above this swing high, Ruben? Why didn't you put it there? Why is your entry here for? Well, I want you to look at the price action before, right? Look at how messy, how choppy this is. That's all low resistance. We push up, we reject. We come back down. When we come back down, if I just zoom in, you might be able to see, guys. This bullish gap gets inverted. Beautiful. This is a breakaway gap on the 1 minute chart. We're looking at the 30 second. So that's 2 PD rays. We push down, we invert this fair value gap, which I believe was on the 1 minute too. And then we trade back into it here, trade back into it here, reject, and that's where my entry comes from. So I've gotten what's called, and I'll mention it here, it's called a close proximity entry. Sometimes this will mean your risk to reward could be skewed, but there's ways to manage this because you might, for example, market execute, which I do a lot of the time these days. I'll market execute, and if price is like moving very quickly, you might miss the best entry. You might market execute, right? For example, from a inversion fair value gap, and price just smashes through, right? And your entry is not exactly where you wanted it to be. In turn, you got to put your stop loss in a place that makes sense. So my stop loss, if I show you guys here, look, my stop loss is right here, but why right there and why not above here? Number one, if I put it above here, it's too much risk, right? So I want to put my stop loss in a place where if it gets violated, my trade idea is just incorrect. I've got an inversion fair value gap on the 1 minute. I've got a breakaway gap on the 1 minute. I've got another inversion here on the 30 second, and this up close candle here, this really small one. Have a look in this section. That's an order block. So my stop loss is now above like 3 to 4 PD rays. I do not want price to accumulate and then push back up. I just want it to continue to sell off exactly how it's done. And again, in this situation, it's all about going, okay, what do I want to see with price? Where can my stop loss go? Because I've got a close entry, not exactly where I want it, but a close entry. And that's how you manage your stops. Now, for me personally, could you put it a bit lower? You could, right? You could. But in this situation, based on whatever I'm risking, if I'm on a $50,000 account, if I want to risk 0.5%, if that's going to be 0.5%, great. You know what I mean? And then what I'd probably do in this situation is, as price sells off here, I'm going to trail my stop loss from here to above that inversion fair value gap. When price takes out a prominent swing low right here, I'm going to break even. And then when price starts to expand, I'm going to aggressively trail my stop loss because this is quite a big swing. It's quite a big swing, but the clear draw on liquidity is there. And that's the thing. So if I'm going for like a bigger pull, this is more than a 1 to 2, right? So if I'm going for a bigger pool, more than a 1 to 2, more than, a 10 handle trade, 15 handle trade, it might be 20 handles, for example, I want to trail my stop loss. So price breaks down here, trail my stop above the inversion. Price sweeps this low, trail my stop even further into profit, or at least to break even. As price, approaches 80, 85% of the final TP, roughly probably about here, I'm just going to aggressively move my stop. Like we accumulate, we expand, I'm just going to aggressively move it into profit. That way, regardless, I pull away what I need to pull away. And then as price gets closer and closer, I just aggressively trail it. Because there's been situations in the past where you guys might have experienced the same thing. You get super close to the TP, right? The greed kicks in. You're like, nah, I'm leaving my stop loss where it is, or I'm leaving my stop loss at break even. Price comes all the way back up and it'll stop you out. So if you're not going to take pass-throughs, if you want like a full pool, or if you're in with one contract, this is the way that you do it, or that I personally do it. And again, it's all up to you how you do it. But again, in this situation, there's multiple PDRAs that are supporting price. And this is just a very typical example that might happen if you're trading like the New York session. So this is all London session, that's what I trade, but New York session, your stop loss is going to be massive, right? So if you always go above the swing high and swing low, it's going to be too big. You're not going to be able to risk one contract or one mini. You're going to have to go to micros, which is fine. But if you're looking for minis, for example, and you're trading when there's more volume or volatility, you got to get used to putting your stop loss a little bit tighter, right? Somewhere that works for you. And that's all personal based, right? So again, I'm not a financial advisor. This is just personally what I do. And this is how I kind of frame my trades in terms of the stop loss placement and the TP levels and trailing my stops, especially if I'm going for like a bigger, like full pull. This is exactly, what I do. So example number 4, really good example here to take a look at as well. And then finally, example number 5, this is more of a swing model or holding trades, for a few hours. It's something that I've been experimenting with slowly but surely over the last couple of months. And I just want you to have a look at this, right? So in this case, we sweep London lows, right? There's SMT, these lows. We have a shift in structure. We return back into a bullish gap. That's my entry. I want to take price all the way up to the all-time highs, which is great. In this situation, it's a one contract trade. And I know a lot of people in my Discord or people that I've mentored, they say to me, Ruben, like, how do I manage my trade if I've only got one contract? If I'm only willing to risk one micro, one mini, how do I do it, right? The first way is to just have a fixed risk reward. That's the easiest. You go, okay, I'm going for a fixed 1 to 2 or a fixed, 10 handles, 15 handles, depending on the session that you're trading. And that's it. Go for a fixed one, you're done and dusted. But in this situation, say you're holding on to a trade and you're thinking, okay, what can I do? How can I manage my stops? Originally, it's very typical. Right? I'm only in with one contract. So if I'm in one contract, I'm willing to have the stop loss a little bit more than usual. Entry from this busy, limit order. Stop loss below the low that creates the SMT, very typical. And then obviously TP at this swing higher. But you might be saying, what about this? What about this price action? Do you trail your stop? When do you trail your stop? How do you know it's too early or too late? Like, what do you personally do? And for this last page, we're going to go through that in a little bit more depth, right? So again, this is the original entry price. Now, as we're watching price play out, and let me just zoom in here so you guys can see. As we're watching price play out, price comes up here, right up here, comes back down. Low resistance buy side, comes back down. Sweeps this sell side, taps into this bullish imbalance, displaces higher. I'm now moving my stop above this swing low into profit. Why should price sweep liquidity displace higher and stop this low out? It shouldn't, because that low should be protected considering it's just swept liquidity. Cool. Price continues, it comes back down, forms a higher swing low here, a higher swing low. This is called a failure swing. When does it become an important failure swing? When we push up and we disrespect this imbalance. Right, so we're showing reversal price signatures here. So really, really important. When we have this failure swing, then guess what? I'm moving my stop loss up again. Price comes here, mucks around, comes back down, sweeps this low. It's hard to see, but just by a tick, sweeps the low, rejects, inverts a fair value gap here. I'm now moving my stop loss below this swing low. So notice how I'm trailing my stop loss. If I'm in with one contract, which is this example, one contract, one mini, I'm not going to just go to break even and then let it come all the way here and then get stopped to break even. There's no way, right? So you always got to pay yourself as a trader. Price comes here, displaces higher. After this, I'm aggressively moving it, right? Moving the stop loss below this low. Price comes up here, creates two relatively equal highs, right? I like to see that. We come down low, I'm just watching price. We start to move higher here. I'm moving my stop loss below this low. Aggressive, and then price obviously takes out the TP level. So again, as price works in my favor, this is really important. I'm now waiting for another internal sweep of sell side. When you sweep sell side or buy side liquidity and you're watching a move, you should displace after doing that, right? And in this situation here, you can see, right, you've swept sell side, you've tapped into an imbalance, you just place higher. You have a failure swing low, you just place higher. You sweep sell side by a tick, invert this fair value gap, have a failure swing low, just place higher. This now should be protected, you can start to trail up. So it's just one of the things you can, experiment with and have a look at. But I hope you guys have got something from this video. And again, end of these videos, just so I know who is staying and watching these whole things, comment stop loss below. If you comment stop loss, I know you've been here for the whole video, right? Because it's been quite a long one. And I hope you got some value out of this video. This is one of 10 modules. Again, if you want this PDF, the link to my free Discord will be in the description of this video. I've got a free and a paid Discord. This will all be for free. All videos on YouTube, the PDFs will be for free, and they'll be posted in the Discord as these videos come out. But until next time, guys, I'll talk to you then. Peace.